Today, we're diving into an analysis report called Hidden Gem, NUKK's massive shift into defense and space tech.
It details Nucleus Inc.'s pivot from fintech into becoming an aerospace and defense aggregator.
Right, with a laser focus on the Iron Dome supply chain. And I think the report's strongest hook is this idea that NUKK is still valued like a fintech company.
When it's holding these really serious, defense assets.
Exactly. That repricing opportunity is the whole game here. But I think the way the analysis is framed, it needs a little work to really land with conviction.
I agree. That core strength, the valuation disconnect, it's clear. But I wonder if the report has really framed the risk side of this high-risk, high-reward argument properly.
What do you mean by that?
Well, to properly frame NUKK as a true special situation, the high-level financial risks, I'm thinking specifically about potential dilution, they really need to be introduced much earlier in the report.
Like in the executive summary?
Ideally, yes, right up front.
I can kind of see why they did it this way, though. Lead with the good news, the Remon acquisition, get the reader excited.
And then hit them with the financing structure later on.
But for a story about such an aggressive pivot, isn't burying the lead on risk? Doesn't that fundamentally damage the credibility of the whole piece?
It absolutely does. That's the weakness, the really significant financial risks. You've got the high cash burn rates and that critical funding mechanism, the $250 million equity line.
Which is everything for their growth.
It is, but they're currently stuck way back in sections 5 and 6.
Right.
And that separation, it breaks the narrative. By the time the reader gets to those caveats, they feel like they've been sold half a story.
Let's just pause on that equity line for a second. That $250 million, it's the engine for growth, but it's fueled by dilution. They draw down capital and existing shareholders get diluted. That is the elephant in the room for this whole transition.
It is, and the report presents this incredible pivot narrative, almost completely separated from the cost of that pivot. So our suggestion is to weave these crucial financial caveats into the story from the very start.
So you manage expectations immediately.
Exactly. You give essential context for the volatility. It frames the valuation disconnect in the right way. It's cheap because it's risky. And that risk is quantifiable.
Okay, so practically how do we do that in the summary without just bogging it down with numbers?
Well, a concrete step is to just amend the hidden gem thesis itself in the executive summary.
Okay.
Acknowledge right away that this repricing opportunity is directly offset by the heavily capitalized nature of the pivot.
And that it's funded by that potentially dilutive equity line.
Yes. That single sentence contextualizes the entire investment thesis immediately.
I like that.
And another thing, when the report discusses immediate operational needs, it should explicitly connect that recently closed $10 million private placement to the current high cash burn.
So the reader understands the urgency.
Precisely. You're showing them the fuel gauge is low, even if the destination is, incredibly profitable. It adds that necessary tension.
That makes perfect sense. Shifting from a simple story to a transparent, risk-adjusted thesis right from the jump. Essential for a special situation. Okay, let's move on to the assets.
Sure.
The report makes this really intriguing case for a secondary technology angle.
The digital logistics piece?
Right. Highlighting the integration of things like UAVs, GNSS, and using their old fintech payment rails for what it calls digital logistics in defense contracts.
It's a clever idea.
It is. This idea of a dual-use ecosystem is clever, but I was left feeling that this capability wasn't really fully integrated into the financial thesis. It felt a bit separate.
That is the problem. The report has to more explicitly connect that digital logistics and legacy fintech stack to the actual A&D revenue model.
To justify the space and tech angle.
To justify the angle and to show real concrete synergies. Right now, this whole dual-use capability is presented purely as a technological feature.
A neat trick they can do.
A neat trick. But if it doesn't immediately improve the defense unit's margins or speed up their cash cycle, why should an A&D valuation multiple even care about this legacy fintech feature? It feels like a leftover asset, not a strategic advantage.
So the weakness is that it just feels tangential to the main event, which is the Iron Dome catalyst. We need to get this from being a description of tech to a measurable, margin-enhancing advantage.
You've got it. So the suggestion is to reframe that entire section to quantify how this dual-use tech reduces friction, or improves margins, or speeds up settlements.
Which would directly help mitigate that high cash burn rate we were just talking about.
Exactly. The technology has to have a demonstrable economic impact on the new core business.
Okay, but this is complicated stuff. We're talking about really opaque defense contracts. Is it realistic to ask the analysis to quantify a synergy that might not even have happened yet without just making things up?
We don't need certified financials. We just need plausible, context-driven projections. For example, a concrete step would be to introduce an estimated revenue synergy or an efficiency metric for that digital logistics piece.
How so?
Okay, that's interesting. Or you could try to quantify the benefit in terms of reducing cross-border friction. Frame the fintech integration as a direct cost reduction or a measurable time-to-settlement advantage over the old way of doing things.
So give me an example of that.
Well, let's say NUKK's proprietary rails can shave, say, 45 days off a typical 90-day settlement cycle for sourcing international components.
That would be a massive improvement in working capital.
Massive! And that is a real competitive edge that would absolutely warrant inclusion in the valuation.
That's powerful. You're turning a legacy fintech asset into a quantitative way to solve one of the defense sector's biggest headaches, working capital.
It goes from being a list of features to a defined economic advantage.
Okay. Let's look at the third major catalyst the report identifies, the $150 million SPAC, SCI Acquisition Corp.
The war chest.
Exactly. The report correctly flags its role as a way for NUKK to hunt for huge targets, like a massive private defense firm that wants to go public, without directly diluting NUKK's own shareholders.
It lets them punch way above their weight class, no question.
The potential is massive.
It is. However, while that SPAC is correctly identified as a huge catalyst for asset growth, the analysis really should project potential target profiles and acquisition timelines to ground the strategic value for the reader.
I agree. The weakness I saw was that this tool just felt strategically detached. We spend all this time detailing the specialized rim and iron dome supply chain focus.
And then the SPAC is described generically?
Yes, it can merge with any massive private defense firm. That lack of a specific tie-in to their existing strategy makes that $150 million war chest feel completely theoretical.
It does. Without defining the strategic target, the reader struggles to visualize how this value actually gets unlocked, and more importantly, why it's synergistic. We need to strengthen that forward-looking aspect by defining the types of targets that would maximize synergy with what they already have.
So, moving the argument from potential to plausible.
And integrating it tightly with that overall Iron Dome narrative.
It's the difference between saying we might buy something big and saying we are specifically looking to acquire assets that complement our specialized power and subsystem expertise.
You've nailed it. And concrete examples are crucial here. So the report could suggest outlining 2 or 3 specific defense verticals the SPAC might target that directly complement Rimon's focus.
Like what, for instance?
Well, are they aiming for, say, guidance systems manufacturers to control more of that component supply chain? Or maybe specialized defense software analytics firms for better platform management?
I see. So it connects back to the core business.
Exactly. Giving the reader clear, synergistic examples makes the $150 million seem like a purposeful weapon, not just a pile of cash.
And what about the timeline?
Well, the SPAC process is long, so managing expectations on timing is essential. I'd recommend integrating a projected timeline for the target identification, even setting a speculative target announcement date, like, say, target announced mid-2026, helps manage expectations.
Right, it reinforces that this is patient, strategic growth.
Not a quick flip.
This has been incredibly insightful. So to recap, we've identified 3 main areas to strengthen this analysis. First, better integration of the financial risk early on, just for upfront transparency.
Right.
Second, actually putting a number on the revenue synergy of that digital logistics tech to turn it from a feature into a real economic advantage.
Yeah, make it tangible.
And third, grounding the potential of that huge SPAC with specific, synergistic targets and a realistic timeline.
And I think the overarching actionable theme here is really integration and focus.
How so?
The analysis report has to strive to link every non-Rimon element, the SPAC, the digital logistics, the dilution risk, directly back to that primary Iron Dome and defense revenue thesis.
So it's all one cohesive story.
It has to be. If you can create that seamless, high-conviction narrative for what is a very high-risk, high-reward special situation, you're going to maximize the reader's experience and the overall impact of the piece.
This is already a very strong premise, and I think incorporating these strategic refinements would transform it into a truly robust, integrated investment thesis.